capital budgeting, that is NPV. So here NPV is based on a zero period, that is today. So it is based on a zero period and which is goes on for the year on year. This process is called as discounting. NPV, we all know as NPV is equal to discounted cash inflow minus discounted cash outflow of cash outflow. So this is a format regarding showing the present value of cash outflow, that is particulars, year, PV factor, amount and PV. So here purchase of new machinery starts today, that is zero period, and PV factor always be 1, and the amount and PV is always be same. The freight charges installation, which is also in a zero period, happens, and the PV factor is 1, the amount will be same. The workers trainer expenses, this is also from a zero period and the PV factor will be 1. All these three, purchase price of new machinery, freight charges and installation, and workers training experience, comes for depreciation. So after that, with all these three, we deduct the subsidies from a government. Why we deduct the subsidies from the government? In the past video I said the subsidies is from the government, is for SEZ, special economic zone. Subsidy gets from a cash outflow which you are paying for the machinery. That machinery, what the price has been you but paid by the business, has been given back by the government as a subsidy. That amount is deductible here on the year of receipt, that is on a PV factor on a respective years, which will be deducted here. So next one was initial working capital was under zero period, it is for factor 1, and the additional working capital and year of requirement. What are the additional working capital, how many years you require those additional working capital, and PV on the respective years. So additional equipment is based on retrenchment, and additional equipment and retrenchment compensations are related. Why? Because this additional, for example, this additional equipment was bought for the business from Germany. Germany imported machinery to manufacture a T-shirt. Because this machinery use sending back home those workers who worked in the place of machineries. When you bought the machineries from import, you send back those staffs to the home. The staff will ask you like, without any intimation, you are sending us back, we too have a family. So here, so the businessman will give a advance salary for some months and retreat the employees back. So they'll send back the employees, and which is also called a golden handshake. This machinery sending back home some of your staff by giving advance salary is called as retrenchment compensation. This is happens from zero period and PV factor of year 1 and minus tax savings on retrenchment compensation. What happens on retrenchment compensation means you have a retrenchment compensation a previous year retrenchment compensation has been happened, and the tax savings will be taken into consideration on the next year of retrenchment compensation. Very important. And the another note was the freight and the worker training expansion are to be capitalized in the sense added to the purchase price of assets, since these expenses have been incurred before the asset is put to use. So next, after that, how the NPV is calculated. This NPV is calculated CFAT, that is 10th one CFAT of year 1. This is a continuation of previous format. CFAT for year 1, it comes to 1 PV factor of a particular year and the amount and the PV value. And this goes on to 1, 2, 3, 4. Later on, we used to calculate final NPV. Final NPV app be 11 minus 9 plus 10 minus 14. 10 minus is 14 is nothing but CFAT 1 to CFAT 1 5, and 11 was CFAT 2, and the tax saving retrenchment compensation is deducted, and we add back two factor here. If the NPV, if we get NPV is greater than 0, we accept those NPV. If the NPV is lesser than 0, we reject those NPV. Net present value, that is NPV. We all know net present value is equal to present value cash inflow minus present value cash outflow. How to compare mutually exclusive project? Under capital budgeting, under NPV, how we compare the mutually exclusive project which have unequal lives? Unequal lives is nothing but the life of the machinery. If in case some of machinery X as a 5 years and machinery Y as a 8 year, by following example I am saying this: if the machinery X has a 5 years and machinery Y as a 8 year, these years are called as uneven lives. So under that machinery X NPV, for per year it is 5 years, and for machinery Y it is 8 years. So this NPV is a net benefit earned over the period of the project. So let's come to the example problem, that is particular machinery X and machinery Y. This is a question. Purchase price of machinery X was 5 lakh, machinery Y was 8 lakh. Useful life is machinery X is 5 years, Y is 8 years. Estimation salvage of both the X and Y is nil. Method of depreciation is straight line method. For both the X and Y, the rate of machinery X is 30%, the tax rate of machinery Y is 30%. The annual sales of machinery X is 10 lakh, annual sales of machinery Y is 10 lakh. Variable cost of machinery X is 40% of sales. Variable cost of machinery Y is 30% of sales. Fixed cost other than depreciation per annum for machinery X is 1 lakh and the machinery Y is 2 lakh. Annuity factor 5 divided by 5 is nothing but the machinery X life of machinery, and the Y years is machinery Y lifetime years at 10%. That comes to annuity factor is given here 3.791 for 5 years, that to machinery X, and 5.335 for 8 years, that is machinery Y, which the above machinery should be purchased on the basis of NPV. We used to calculate which is best to purchase, machinery Y or machinery X. So now we are calculating the depreciation at very initial stage. Y is equal to 5 lakh. That is the price of machinery divided by 5. The period of life is equal to 1 lakh, and Y 8 lakh divided by 8 is equal to 1 lakh. Now we are calculating calculation of CFAT, particulars machinery X and machinery Y. The sales of machinery X is 10 lakh, machinery Y is 10 lakh minus variable cost. Variable cost on sales, X is 40%, that comes to 4 lakh, Y is 30%, that comes to 3 lakh. Now the deducted depreciation, now we already calculate the depreciation. This depreciation is 1 lakh and 1 lakh, and the fixed cost other than depreciation for Y X and Y. X is 1 lakh, Y is 2 lakh. Earning before tax for both the X and Y is 4 lakh, and minus deducted by 30% on 4 lakh for both Y and X comes to 1 lakh 20,000. We add back the depreciation, that is 1 lakh and 1 lakh. That CF80 for 1 year comes to 3 lakh 80,000 for X and 3 lakh 80,000 for Y. So here we used to calculate CFIT on the basis of year. CFIT 3 lakh 80,000 into 5 comes to 19 lakh, and CFIT 3 lakh 80,000 for Y, 3 lakh 80,000 into 8 comes to 30 lakh 40,000. So now we calculate NPV particulars year PV, and the X amount XPV, Y amount YPV. Purchase 0 years PV1. So both the PVs of X and Y will be same, 5 lakh and 8 lakh, and CFAT 1 year comes to 3.791 for 5 years, that is 3 lakh 80,000 for amount. The PV value is 3 lakh 80,000 into 3.791 comes to 14 lakh 45,800. sorry, 1,44,580, 3,80,000 into 3.791 comes to 1,44,550. So this is for X, and the CFIT for 8 years, that too for Y. The same 3,80,000 for per year, we convert into a PV for 8 years, that the PV factor is 5.335. So 3,80,000 into 5.335, that comes to 20 lakh 27,300. So now we calculate NPV. NPV 1 is equal to we deduct 5 lakh minus this 1 lakh 40, 1 lakh 44 580, and same 8 lakh minus 2 lakh, we add back this thing, 5 lakh plus 1 lakh 44,580, and 8 lakhs plus 202730. It comes to NPV 1, and the annuity factor was given here 3.791 and 5.335. This is divided by NPV, but divided by annuity factor comes to 2,48,109 for X, and 2 lakh 2,30,047 rupees for Y. This both 2,48,000 and 2,30,000 will be the NPV, if which is a great, which is the NPV value should be internal rate of return. Here rate of return is benefit from the investment. What we invest, cash outflow will be happen. In return, what we get is a benefit from the investment. Here we does not calculate the amount, we only calculate the rate of return. Rate of return, IRR is the rate of return earned by the project. IRR also talks about cash flows, which is cash inflow and outflow. In inflow we have a present value of cash inflow, and in cash outflow we have a present value of cash outflow. In present value of cash inflow, we have a present value of cash inflow. For example, I have a 1 lakh rupee. So here we are going to learn how the NPV and IRR works. So in NPV, I have a cash of 1 lakh rupee. In NPV, I used to have also have a benefit like a monetary form. In IRR, we have a benefit of rate of return. I have a 1 lakh rupee, so I invest. I invest where the cash inflows goes to the project of 1 lakh rupee. So here we always believe to recovery the investment amount. We should have a recovery amount of what we invested, we used to get back, that is 1 lakh. Also should be outflow for the project, that is 1 lakh. So IRR is equal to present value of cash inflow is equal to present value of cash outflow. IRR is a discount rate in which the present value of cash inflow is equal to present value of cash outflow. In other words, it is a discount rate at which NPV is 0. Why here NPV is 0? Because we only expect what we invested to get back. That investment is to be get back it with the same amount. Here I invested 1 lakh rupees, and I used to have that 1 lakh rupees back to my business. So we does not expect any gain here, so that NPV is 0. In NPV, discount rate is cost of capital. Now we are going to learn how does IRR and the cost of capital works. IRR, internal rate of return, which I have. If I have a rupees 1 lakh rupee in my pocket, I have a two options of investment where I can investment to the FD, that is fixed deposit in the bank, which I have a return of 8%. I have another option of fixed asset investment, that comes to IRR, which have a returns of 10%. In IRR, if I have a return of investment comes to the fixed asset, which has the returns of 10%. And in cost of capital, the return of investment which I investment to the FD, that is fixed deposit, which has been the return of 8%. Here I used to seek for the higher returns, that is 10%, and I go with the IRR. Decision criteria for IRR is, if IRR is greater than or equal to the cost of capital, the project under the consideration is acceptable, and the IRR cost of capital is lesser than or equal to the cost of capital, the project under consideration is rejected. So later, if you have a more than one project, what is the criteria? We have a mutually exclusive. As we all learned, mutually exclusive is one project is accepted, automatically another project is rejected. In this case, how we accept the project means the project with the high internal rate of return will be accepted. If in the complementary thing, if you accept the one project, the project complementary or other another project complementary with with the complementary project of project 1, you automatically accept the project 2 as a complementary. For example, uh, if you going to buy the saving Gillette shaving set, you buy the Gillette shaving set, automatically the free complement of Gillette blade has been given. This is an example for complementary decisions. So if one product is accepted, the another complementary product followed, product 2 is followed to you. So here combined IRR is greater than cost of capital only when you accept the project. So here the independent decisions or independent project happens, no related to the similar product. The product are very different, the product varies, no talk about accept or reject, because here the two independent projects happen. So you can't compare coffee with tea. Coffee and tea are two different products that does not match each other. So all the projects have IRR is greater than or equal to the cost of capital will be accepted. How we compute the IRR? Computation of IRR, one, we have a lump sum cash method. Under 0 period I invest 10 lakh, and after within a year I invest 12 lakh. And we have a equal cash flow method and unequal cash flow method. Next we are going to learn about in further classes. Thank you. Have a great day. Thank you for all your subscriptions. In last video, as I told, I have a 34 subscription. Now that the subscription has been increased for 35 and 36 and 37. Thank you so much guys. Welcome to Commerce Divine YouTube channel. Expect ಬೆಟರ್ ವಿಡಿಯೋಸ್, ಇನ್ನೂ ಚೆನ್ನಾಗಿರೋ ವಿಡಿಯೋಸ್ ಮಾಡ್ತೀನಿ. ಪ್ಲೀಸ್ ಕಮೆಂಟ್ ಮಾಡಿ. ಹಾಗೆ ನಿಮ್ಮ ಅಭಿಪ್ರಾಯಗಳನ್ನ ಕಮೆಂಟ್ ಬಾಕ್ಸಲ್ಲಿ ತಿಳಿಸಿ. ನಿಮಗೆ ಯಾವುದೇ ತರಹದ ಟಾಪಿಕ್ ಬೇಕಾದರೂ ಐ explain it in further classes. Thank you so much. Have a great day, guys.